So today I want to address one of the most common questions I see from people who want to start investing. Namely, I have some extra savings, how do I start investing for retirement? The short answer is that it depends on your financial situation and your personal financial goals. But for those of you out there asking this question, I've created this video specifically to outline the safest path towards preparing for retirement in the hopes that it will point you in the right direction. So with that, let's get started. The first thing you should consider doing is building up an emergency fund. It just doesn't make sense to start investing until you've set aside enough cash to cover unexpected expenses without breaking the bank. Think of it like a little insurance policy against bad luck. You could lose your job, car repairs, home repairs, any number of things. Without an emergency fund, you'll be forced to use your credit card to cover these expenses, which means costly interest payments. I recommend most people to keep 3 to 6 months of their average monthly spend as an emergency fund. That's generally enough to avoid breaking out the credit card for most situations. Let's say you normally spend $2,000 a month. In that case, you'd want $6,000 to $12,000 set aside as an emergency fund. Once you have an emergency fund in place, your next priority should be eliminating high interest debt. I think of this as any debt over 5% interest. If you don't know the interest rate on all of your loans and credit cards, I highly recommend you find out ASAP. Once you have that information, then rank them from highest to lowest interest and focus any extra savings on paying them off. Once you've put those monthly debt payments behind you, you'll be building up additional savings even faster than before. At this point, you're ready to really start investing towards retirement. The majority of your retirement investments are going to be in securities, which is a fancy word for financial instruments like stocks, bonds, mutual funds, that sort of thing. In order to buy and sell securities, you need to open an account at a brokerage firm. A brokerage firm is a company that acts as an intermediary and matches people who want to sell a security with those who want to buy that security. You can't just buy a stock or bond out of thin air, someone has to be willing to sell it to you. Brokerage firms play an important role in bringing a large number of buyers and sellers together and then facilitating these transactions by making them easier for both parties in exchange for a fee. One of the best retirement accounts to start with is a 401k. This is generally offered through an employer and lets you take money from your paycheck before you pay taxes on it and use that money to invest. In the investing world, we call this pre-tax money. Unfortunately, you'll still have to pay taxes on any growth in value that your investments have had once you sell them in retirement. Many employers also offer to match some percentage of the money you put into your 401k, so be sure to find out if that's available to you and take full advantage of it. Be aware that 401ks do have an annual contribution limit. This is set by the IRS, and it means there's a maximum amount you can put into your 401k every year. For 2021, the limit is $19,500. There are some exceptions to this rule, which you can find detailed on the IRS website, which I've linked below. Reaching the point where you can max your 401k each year is a major milestone and will go a long way towards building your retirement nest egg. If you don't have a 401k available to you, or you've already reached your annual contribution limit, the next account type you want to look into is an individual retirement account, more commonly referred to as an IRA. IRAs are available to anyone simply by opening a personal brokerage account. There are many brokerage platforms out there to choose from. Each has varying levels of fee and convenience or is targeted to a different type of investor. Once you have an account, you'll see the two primary types of IRA to choose from, traditional and Roth. A traditional IRA works similar to a 401k, but rather than putting your money in pre-tax, the amount you contribute will be tax deductible, which basically means you get those taxes you paid on that money back when you file your tax returns. The amount that's tax deductible decreases as your household income goes up. So I've put a link in the description to a table that shows the different tax treatments based on your income so you can check how it affects you personally. A Roth IRA is the opposite of a 401k. Here you pay taxes on the money before you put it into the account. It's not tax deductible like a traditional IRA is, but when you withdraw the money in retirement, you actually won't owe any taxes on the growth in value of your investments, which is pretty great. Roth IRAs unfortunately have income limits as well, and I've added a link in the description where you can see those details in case it applies to you. IRAs also have an annual contribution limit set by the IRS. For 2021, that's $6,000 total across all types of IRAs. With income restrictions on Roth IRA contributions and income restrictions on traditional IRA tax deductibility, I highly recommend starting investing in these accounts as early in your career as possible while you still have the option. So once you put your money into your 401k or IRA, what type of security should you buy? This is a topic that could fill an entire series of videos, but I'm going to condense it down to a few of the most important points here. Number 1, diversification. This is just a fancy word for not putting all of your eggs in one basket. It's much riskier to own a single stock or bond than it is to own a diverse collection of stocks and bonds. The idea is that if you're well diversified, no single stock crashing is going to empty your retirement savings. This point brings me to number 2, which is buy index funds. Index funds are collections of many stocks and bonds that are designed specifically to help diversify your portfolio by containing many companies from across an entire financial index, like the S&P 500, for example. Buying index funds is significantly less complicated than trying to build your own well-diversified portfolio of hundreds of stocks. Number 3 is to look for low management fees, also called the expense ratio. The downside to buying these bundled groups of securities like an index fund is that someone has to professionally manage them and ensure they're well diversified. Whoever does this charges a fee for their service, which is calculated as a percentage of the total amount you have invested with them. The fund manager earns this fee even if the fund loses money, so it's critical to your long-term return that you get as low of a fee as possible. These fees generally range from as low as 0.02% to as high as 1.5 or 2%. I personally have never invested in anything with an expense ratio higher than 0.1%. And number 4 is just a word of advice. Don't check your investment performance every day or even every week. The stock market goes up and down constantly from minute to minute, but you're investing for a retirement that may be decades away, so the value today or right now is largely irrelevant. Don't stress yourself out over daily fluctuations in values. This is a set it and forget it investment approach that gives you the best chance of being financially ready for retirement when the time comes. If you manage to max your 401k and IRA, then you're easily in the top 5% of the population for retirement savings. Let's take a look at an example scenario of how compounding interest makes retirement achievable if you can reach this point. Let's say you max your 401k and IRA each year for 30 years. If you invest that and earn an achievable 8% annual return, then at the end of 30 years, you would have saved a total of $765,000, but your retirement account value would be worth a whopping $3.12 million. At this point in your journey to retirement, you're making huge strides towards financial independence every year as your investments grow and compound. If you have extra savings to invest at this point and want to move your retirement date even closer, then I recommend working to reduce your remaining fixed costs, which means paying down any low-interest debt which we've largely ignored so far. Retirement is about reaching a point where your passive income exceeds your costs. All the investing you've done up to this point has built a sizable nest egg that's intended to generate as much passive income as possible. If you can now lower your costs as well, then the gap between passive income and costs gets that much smaller. For most people, their largest fixed cost is their mortgage. You may also have student loans or other low-interest debt that needs to be paid off. This is the time to focus on becoming 100% debt-free to further reduce your monthly cash flow needs in retirement. If you've reached your debt-free milestone and want to try some higher risk investments, that's great. There's a lot of options out there, but each of them really requires specific knowledge and available capital if you want to be successful. These speculative investments have an inherently high failure rate, but if you get lucky, the upside can be life-changing, so many people do choose to dabble in them at some point. My recommendation here is that you limit your speculative investments to an amount you can afford to lose without hurting your retirement plans. Some examples of investments in this category that I've personally invested in are private loans, corporate debt, rental properties, cryptocurrency, day trading. There are new financial vehicles being invented all the time, so keep an eye out for what looks interesting to you. Hopefully this video has given you some ideas about what to do with that extra savings sitting in your bank account. If you found it helpful, then please do subscribe, as I have a lot more content on the way. If you have any questions or suggested topics you'd like to see in a future video, please share them with me in the comments below. See you next time.